Hello everyone. In this video, we're going to look at notes receivable. It's a more formal receivable and it's not coming from the day-to-day transaction with the customers, but it can also be used to replace accounts receivables. And this is the example we're going to see. So notes receivable has a principal and the interest must be recognized within an accounting period. Okay, so let's take a look at this. Dover Electric Company purchase on account. Dover is the customer. $50,000 of consulting services from DAG Limited. That's us, the company, on November 1, 2026. The amount is due in full on January 1st, 2027. So the company recognized accounts receivable. So let's put here accounts receivable $50,000, credit sales revenue $50,000. That's on November 1st, 2026. Dover Electric, the customer, is unable to pay the account by the due date and negotiates an extension with a 10% notes. For them, it's notes payable. For us, it's notes receivable in lieu of the unpaid accounts receivable. So we're changing from accounts receivable to notes receivable, but now the customer is going to pay interest. With accounts receivable, the customer didn't have to pay interest, but because they couldn't pay us, they changed it to notes receivable. They're going to pay 10% interest. 10% is the annual rate. Okay, so the amount is 50,000 and the annual interest is 10%. Okay, so the next question is how much, and then journal entry for the modification. So from accounts receivable here, we are going to change it to notes receivable. More formal contract, usually larger amount, usually longer term, it carries interest, and from parties that are not really customers, except for this example when the customer is replacing accounts receivable with notes receivable. So we change from accounts receivable, we credit accounts receivable, so now it's gone, no longer in our balance sheet, but now we have this new notes receivable for $50,000. Okay, and then how much interest will be paid if Dover Electric repays the note on July 1st, 2027, December 31st, 2027, and March 31st, 2028. So there are three different dates. The amount will be $50,000. Annual interest rate is 10%. From January 1st through July 1st is January, February, March, April, May, June. So that's 6 months. That means the total interest that we will receive is 10% times 50,000 times 6 divided by 12 for half year, because that 10% is annual basis, annual rate, so we have to multiply by 6 months divided by 12 months. So $2,500 is the total interest if it's paid in July 1st, 2027. What if it's December 31st, 2027? So the notes receivable is 50,000, 10%. That's 12 months from January 1st through December 31st. So that means 10% times 50,000. Let's put $sign there. Okay, and this is a percentage. Oops. Okay, 10%. So the interest for the whole year is $5,000. Okay, and then the next one is if it's paid March 31st, 2028. The face value is still 50,000. The interest rate is 10%. Okay, but now 12 months plus January, February, and March, 3 months plus 12 is 15 months. So the total interest will be 10% times $50,000 times 15 divided by 12, going to be 6,250. So that's how we calculate the total interest that we are going to receive depending on the payment dates. Okay, now the next one is prepare the adjusting entry to accrue interest on December 31st, 2027. So on December 31st, 2027, we're not going to receive any interest payment, but we have to recognize interest revenue or interest income. Okay, and that is requiring adjusting entry on December 31st, 2027. And because the payment is not going to be received until March 31st, 2028, so we are going to recognize interest receivable. And because this is for the whole year, it's going to be $5,000. And we recognize interest income, $5,000. And this is just for the interest, not the $50,000 pay receivable itself. Okay, and then the last one, prepare the journal entries to record the cash received to pay off the note and interest on each of the 3 dates in requirement 2. So we already calculated the amount of interest. Now let's take a look at the journal entries when we receive the money. Okay, so debit will be cash. And then we have interest income for the first one is 2,500. So interest income is 2,500. And then notes receivable will have to be canceled. Receivable will be canceled for $50,000. So that means we are going to receive cash $52,500. That's the first date, July 1st, 2027. What if the payment is done at the end of December? So we will receive cash. We will recognize interest income. This time it's for 12 months. So we're going to use the second one here, $5,000. And then we cancel the notes receivable, $50,000. So cash will be $55,000. Okay, that's the journal entry for the payment on December 31st, 2027. Now, what if we receive the payment March 31st, 2028? Okay, so we are going to receive cash. We are going to cancel the interest receivable we did earlier here. This one, right? $5,000. We have to recognize interest income for January, February, and March, which is 3 months out of 12 times 10%, 10% times 50,000. Okay, 1,250. If you look at this is 1,250 more than that. Okay, so that's for 3 months, 1,250. We need to cancel our notes receivable, $50,000. Okay, so the cash that we are going to receive is $56,250, which is 50,000 plus the total interest here. Okay, so that's how we prepare the different journal entries for different days, different payment time. Make sure that we calculate the interest income correctly, depending whether it's 6 months, 12 months, 15 months, or any other months. Thank you for watching.